Hello and welcome to today's lecture. We're going to be talking about financial risk. Now, in the last module, we talked about the time value of money, and I gave it a tremendous build-up about how important it is. And I stand by that. That is one of the most essential things that you'll learn out of this entire class is the time value of money, but its a close cousin or distant, not too distant relative is financial risk. And we'll be talking about that this week as well. So let's get into our discussion, a little bit of, introduction to what we'll be talking about. And again, that's financial risk, which you may hear as the terms risk and return. I've used some of these terms already in some of our other lectures. Now we're going to delve into more about what these mean, how they are measured, why it is so important to really get this right when you're making your decisions, either from even a personal investment standpoint or as healthcare managers, healthcare leadership, how you're going to make those decisions. Because if you do make the wrong one, like I say in a lot of my lectures, it will be a career limiting maneuver where you could be fired if you make the wrong decisions here for some of these very important high stakes situations that you'll be faced with. Well, let's talk a little bit about some of the financial risk basics. Financial risk is present whenever there is a chance of earning a return on an investment than is less than the amount expected. Now, this is directly from the textbook. But what does this mean? If you read it, less than the amount expected. Think about this. So you've got a situation where you are investing in let's say a pharmaceutical company, and it's a brand new pharmaceutical company. You're going to have, and that investment, let's say, is could be a private stock issuance. They're going to give you some stock or something, or it may be venture capital. Let's go with that, venture capital money, which means kind of new money coming into a company, a new venture, and they want to start this new company because this one scientist has this great idea for pharmaceuticals that's going to make everybody, 200% smarter than what they are. He's invented the smart pill. So, he's asking from you $100,000. You say, yeah, I mean, this is great because I have an expectation. You're going to have an expectation whenever you write that check, whenever you're giving somebody that money, you are going to have an expectation. Now, it may be I'm going to double my money, triple my money. You may have some information that was given to you to build that expectation, but nevertheless, you're going to have an expectation. Now, you're investing in this new pharmaceutical company, brand new, because this guy has this smart pill. And you're also going to know, well, that's pretty risky because you haven't had FDA trials yet. You've only trained this, you've only tested this on, lab animals, on, and on mice. You haven't even tested it on chimps yet. And God only knows what can happen, right? So there is a lot of risk involved there. So inherently, you're going to want some significant return on that money. So when you think of this statement, when uh, whenever there is some chance of earning a return on an investment that is less than the amount expected. Let's say you expect to double your money, okay? But you do realize there's a chance that you're going to earn less than what you expect or hope for, um, you're going to perceive that as greater risk when you look at the probability of that investment basically being zero, right? So let's say, he tries his drug out on chimps and their heads explode and everybody dies. So obviously the drug is no go and you lose all of your money. Versus something very secure where um, you're investing in a major hospital system that's been around for 100 years. They've got a great rating, and we'll talk about ratings when we go throughout the class, but you may hear about Moody's or Standard and Poor's. They've got a great bond rating, meaning they're a really solid company, and you're buying a bond that's going to mature, let's say, in a year, And there's like almost no chance I'm not going to get my money back, right? Unless some major catastrophe befalls this hospital system, which is, and even if it was some catastrophe, it might take a few years before a system, a large corporate entity would decline. So you're like, yeah, there's a very minimal chance I'm not going to get my money back. So in this case, it's going to be less financial risk, and in this case, the expected return, that on it, the expected return that you would require would be less as well. All right, and then kind of in general, kind of summing up just those concepts that I've just said, the greater the probability of a return far below than anticipated, the greater risk. Simply put, risk and return. The more risk, the more return you're going to want on that. Now let's talk a little bit about something called risk aversion. I think we're all naturally, most of us, there are a few and people out there that aren't, but there is a natural inclination towards risk aversion, and we'll speak as to financial risk. And we've got these three categories we've used for years: risk neutral, risk adverse, and risk seeking. Most of us are pretty much risk adverse. It's trying to get what is considered a high return. That's where you have the little bit of fuzziness. I may say to you, yeah, I consider myself risk adverse, but I'm out there investing in 100% stock portfolios. I'm accepting um, 30, 40, 50% fluctuations in my portfolio for my investment. I would say in that case, I'm not really a risk adverse person. You really are taking on quite a bit of risk. But so there is some fuzziness as to where you actually kind of land in these zones. But risk aversion um, is super important when we look at checking our own mental attitudes towards any type of investment that we're making, um, and in this case for our organizations. Are we betting the company on certain things? Now, there are times where desperate measures are required, or there are certain individuals who are very, um, risk seeking. And I'll go back to kind of the Steve Jobs classic situation where he, at a couple of critical times when the company was not exactly financially solvent or strong yet. Apple wasn't financially strong. It wasn't the big cash cow that it is now, where he bet the company on a couple of concepts. The iPhone being one of them. Also, we don't use them anymore because phones have taken the place of that. But we all had iPods too, 15 years ago, right? So, I mean, he bet the company on those devices. And again, it proved off to be a huge payoff and actually opening up entire new industries. But had those failed, I would doubt if Apple would still be here today. So they would have been eventually crushed by other PC makers because they just couldn't. You can't just that PC business is very competitive, and whether Apple would have been able to hang on again for a second time after just nearly avoiding bankruptcy when Steve Jobs came back for the second time. So yes, you can bet the company on certain things, but you don't want to bet the company on an investment that or a project that you don't think is really risking the company, and that's where you could damage your whole organization by taking on a project that you misjudge the risk on. Okay, so we have these categories of risk aversion. Again, very important to kind of know where you kind of fit on the spectrum and where you're looking when you're making choices for the organization.